Hello everybody and welcome to today's Experts Angles webinar, First Home Buyer Super Saver Scheme. Now I don't know about you, but I'm really interested in how this First Home Buyers Super Saver Scheme actually works. So I'm really looking forward to hearing our Experts Angle today. Now my name is Rob Lockhart and I'm just your host for today. This webinar is going to probably last the formal part about 30 minutes, and then I've got at least another 15 minutes or so to answer any questions that you may have. But you don't really want to hear a lot from me today. Who you really want to hear from is Brian Asherton. Brian Asherton is the head of financial literacy and advocacy at BT Advice Services. And let me tell you, he knows a lot more about this topic than I do. Now, Brian has had many years' experience in leading and delivering comprehensive technical solutions to advisors and their clients, with the last 17 years spent with the BT Financial Group. Gosh, can't even read my own writing here. He's got qualifications in law, commerce and financial planning, and being an SMSF Association Specialist Advisor, Brian is a frequent presenter and facilitator at many industry events, and he regularly contributes to trade and consumer publications. So welcome along, Brian.
Thanks, Rob. It's great to be here.
So what I'm really looking forward to hearing from Brian is, all about how this Super Save works. But before I can pass you over to him, we do have a few little house rules that I need to go through to make today work well for you. Now, because there are so many people joining our webinar today, we've put you all in what's called listen-only mode. But this is a live webinar, so we want to answer any questions you have. What you need to do, though, to ask Brian questions is you need to type them into the questions panel. If you're on a desktop or laptop device, it may be on the right-hand side of your screen, or you might see a little tab there on the right-hand side of your screen that you need to click on to open. But once you get that open, you can type in your questions. If you're on a mobile device, such as a phone or a tablet, it may be a question mark at the top or bottom of your screen. You just need to tap on that to open up the questions panel. Type those questions in when you think of them. Now, what Brian's going to do is he's going to go through the formal part of the presentation, which, as I said, will take somewhere between 25 to 30 minutes. And then he's going to have all those questions that you've been typing in there so he can answer your questions as we go forward, which will be absolutely wonderful. One of the other things I need to tell you about is later today, we're going to send you a recorded version of this webinar. So if you miss something, or you want to go back and review anything, or there's somebody else you think would be interested in this webinar, you can do that at a later time. So we're going to tape it and we'll get it out to you as soon as we can. But that brings it to the end of what I have to talk about. So without further ado, I'm handing over to Brian.
Thank you, Rob, and thank you everybody for dialing in and connecting to watch this presentation about the First Home Super Saver Scheme. Now, as we go through the course of this presentation, there's four major topics that I'll cover off. The first is, what is the First Home Super Saver Scheme? Secondly, we'll talk about who is eligible. Thirdly, about how do you actually save towards this scheme and what's the way that it works. And then finally, and perhaps most importantly, we'll talk about how and when you can actually access some of the money that has been saved through this mechanism. Now, if we start off talking about what is the First Home Super Saver Scheme to begin with. Now, the first thing here to understand is that this is a scheme that is offered via essentially the federal government through legislation and utilising the superannuation system. It was first announced about 12 months ago in the 2017 federal budget and came into effect from the 1st of July 2017. So we'll go through and talk about how you save, but any contributions that you have made since the 1st of July 2017 can potentially count towards this new First Home Super Saver Scheme. But with a little bit more detail, what is it? So it is an arrangement that lets you set aside money towards the purchase of a first home. Now, as I said, the money is saved in a concessionally taxed environment, which is the superannuation environment. So as you may be aware, within superannuation, the earnings in that environment are taxed at a rate of 15%. this scheme is also separate and in addition to any other schemes that might be offered, generally at a state or territory level. And I think that's quite important to understand, because you can take the benefits out of this new First Home Super Saver scheme and add it to any other concessions that might be offered in the state or territory in which you live. So some states, for example, will have their own first home owner scheme where they might say, if you meet certain criteria or the value of the property is up to a certain level, that they might actually give you a certain amount that can also be utilised towards the deposit. They might give you some concessions in relation to stamp duty, for example. All of these things you can potentially add together to help you go and purchase that first home. So it's important just to understand that they all go together. It's not replacing anything else or any other benefits or advantages that might be available to you. So let's actually get into it and sort of look at the question about who is actually eligible. So interestingly, when you look at this, really everyone is eligible towards this scheme because you're utilising the superannuation system. Really it says, can you contribute to super? And as a general rule, anyone can contribute to super. Certainly under the age of 65, everyone is eligible to make contributions into the superannuation system. The rules are a little bit more restrictive between 65 and 74 that you have to meet a work test. But let's put that aside. Generally, everyone's eligible to contribute. The real eligibility criteria is actually about when you can access the monies that have been placed into the superannuation system. And what's important here is to look at how this works compared to superannuation normally. Because under the superannuation system, as a general rule, you cannot access the money that you save or has been saved on your behalf through the superannuation system until you are at least age 55, and that is gradually increasing to age 60, and you have met a definition of retirement, or you turn 65. So generally that's the only way that you can access money out of the super system. But with the introduction of this new First Home Super Saver scheme, there is now an additional category or additional ability to access super in limited circumstances that goes towards the purchase of that first home. So in order to do that, the first thing is you have to be over the age of 18. Now again, this doesn't mean that you can't start putting the money away before the age of 18. You just won't be able to access it until after age 18. Secondly, you can never have owned property in Australia. Now, importantly, when it talks about owning property here in Australia, that is not just saying, is it only you that have owned it outright in your own name? It is not about it having been your own home. It is essentially saying that you haven't had that ownership interest in property in Australia in the past. So if you've owned an investment property, if you have owned your own home, it doesn't really matter. It's if you've owned property before, be it residential, be it commercial, be it investment, be it for your own home, if you've owned property before, you will not be eligible under this scheme because it is about the First Home Super Saver scheme. And finally, you have never previously requested a release of money towards a deposit under this scheme. Now, what's important to understand from that perspective is to say it's really a case of you get one opportunity. Now, we'll talk a little bit later about how much you can potentially access, but what this is saying is if you could have accessed, and let's just choose a figure for these purposes of $30,000, but you've chosen to only access $20,000 at this point in time, you cannot go back at any point in the future and request access to the other $10,000. It is only a once-off opportunity to work at how much you want to access under this scheme. Now, having said that that's the eligibility criteria, it is contemplated that there might be some additional circumstances where eligibility will be allowed, and that is for if you've been under certain financial hardship conditions or provisions. Now, essentially what this looks at is to say that if there has been some form of circumstance where you are required to actually have sold your property because of financial hardship provisions, then the tax office has the ability to allow you to access this scheme in the future, and it might be therefore towards the purchase of another home. But that is quite restrictive, and again, it is on application to the Australian Taxation Office. But we'll talk about how you apply to the ATO shortly. So that's the eligibility criteria. So let's now get into the mechanics of how this really works. Now, the first way that it works is clearly the question about how do you start to set aside money towards it? Because again, this is different to the states-based schemes. The state-based schemes basically say, here is an amount of money. This scheme says, how can you help save and help yourself get towards that first deposit, and do it in a concessionally taxed environment, which really should mean more money will be available to you in the longer term. Now, because this is based on the superannuation system, we are generally looking at what are the rules to get money into super. And to do that, there are a couple of different ways. The first of those is a personal contribution after tax. Okay, so that personal contribution after tax basically says you've received some money, maybe through employment, the tax has already been paid on it, you've got an amount left over, you're deciding what you want to do with it. Then if that's the case, you can choose to put that extra money into the superannuation system, and it can then be available and eligible for this scheme into the future. So that's an after tax, or what is sometimes referred to as a non-concessional contribution. The second way is what we'll call a personal pre-tax contribution. So again, what a personal pre-tax contribution essentially is again, you've decided to put some money into the superannuation system, and then you choose to claim a tax deduction towards that contribution. And with other changes that came in from the 1st of July 2017, that eligibility became a tax deduction for a contribution is available for everybody if you choose to put some money into the system. But the amount of a deduction that you can claim for that contribution is restricted, because any contributions that are tax deductible to someone are what we call a concessional contribution, and there is a limit to the level of concessional contributions of $25,000 per year. Because the other type of contribution that can also count towards your concessional contributions are salary sacrificed contributions. So rather than you receiving the money personally and then deciding to put it into superannuation and claim a tax deduction for it, under an employment arrangement, you might be able to choose to have regular contributions made into superannuation on your behalf. So you forego some of your salary for a top up towards your super. Those are salary sacrifice contributions, and they will also count towards that $25,000 limit. What is important under this scheme is that for those voluntary contributions that you make, so that is personal after tax, personal pre-tax that you then choose to claim the deduction for, or salary sacrificed contributions, there's only a maximum of $15,000 across all of those types of contributions collectively that can be counted towards this scheme. Now remember, you can save more than $15,000 a year into super if that's what you want to do. In fact, there's a limit of $100,000 of after-tax contributions, or as I said before, the $25,000 of pre-tax contributions that can be made to super each year, but it's only a maximum of $15,000 that can count towards this scheme. And importantly, any contributions that are compulsory, whether that be from an employer because there's superannuation guarantee, whether they're compulsory contributions under the terms of the superannuation fund, or perhaps under the terms of an award arrangement, those compulsory contributions do not count towards this scheme. So it is only the voluntary nature of contributions that can. So to give you an example, if you were an employee and you're in a position where there was a compulsory amount of, let's say, $15,000 that had to be contributed into your super each year, maybe under an award arrangement or under superannuation guarantee, then in terms of any concessional contributions, there's only $10,000 left of that standard $25,000 limit available to you. So only $10,000 of those voluntary pre-tax contributions can count, but of course you can also make another $5,000 of post-tax contribution to get you towards that $15,000 limit. Now, the rules for getting money into super can be quite complex, and there are these limitations. So as part of any contribution strategy, as part of you looking to utilise this first home super saver schemes, I would encourage you to seek some advice about how it will operate in your personal circumstances to make sure that you're doing things the right way and doing them at the right time. Now, getting the money into the system is an important thing. As we said, $15,000 per year, and you can spread this out over a number of years. But of course, the question will then be about how and when can I actually access those monies to take them out to go and purchase that property. So let's talk about that process. Now, the way this system works is essentially it is the Australian Taxation Office that will administer the scheme. So the Australian Taxation Office will work out how much you can get. The Australian Tax Office will essentially get the money for you and pay it to you, so you can then utilise it towards a deposit. But they've got a whole mechanism that they follow. Now, the maximum amount that you can actually access under this scheme is a maximum of $30,000 worth of contributions that have gone in, plus any associated earnings. Now, it's very important to understand here that when we say it's $30,000 worth of contributions that have gone in, this is impacted by the type of contribution that you make and how it is actually taxed within the superannuation system. Because if we go back to the types of contributions we made before, essentially there were pre-tax or post-tax contributions. For anything that is a post-tax or a non-concessional contribution, when it goes into the fund, there is no taxation applied to that contribution. And so the full amount of that contribution, up to this $15,000 per year going in and the $30,000 coming out, the full amount of that contribution can come back out to you. If it's a pre-tax contribution, so that might be the salary sacrifice contribution or the personal contribution that you then choose to take a tax deduction for, those sorts of contributions will be taxed at 15% within the fund, which means there is only 85% of it left over. So when we look at this $30,000 limit, let me use an example that if you had $10,000 of pre-tax contributions going in, that means 15% or $1,500 in tax would be taken out. There's $8,500 left over. When we look at that against this $30,000 limit, it will say what was the contribution going in, which was $10,000 going in. So $10,000 counts towards this $30,000 total, even though you can actually only get $8,500 of it back out. So it is a little bit confusing. There is also some earnings that the ATO will calculate for you. They have an assumed rate of return that they will use to calculate this, because it saves going and working out how was the money actually invested and did you outperform or underperform that deemed rate of return. And at the moment, that rate of return is about 5% per annum. So they will go through and work out what's the amount of earnings that you can get out in addition to that $30,000 level. The one good thing under this scheme is you don't have to go and work out what is that figure yourself. The first step in the process is you actually apply to the ATO, and you do this online. And essentially all you're doing is asking the ATO to tell you what's the maximum amount that you could earn based on the contributions that have gone in, the timing of those contributions, and that deemed earning rate. The ATO will then tell you how much you can access. You can choose not to access anything at that point in time and go back and ask them later for how much can I access now, because you might have had additional contributions. So all you're doing is asking them to tell you what the figure could be. It's not until you actually physically access the money that you've triggered, that's the one and only time that you can ever access it. There are some other rules that the ATO will apply in determining how much can be released to you and essentially when it comes from. Now the rules work on a first in, first out basis. So essentially it will be any contributions or any eligible contributions that are made from the 1st of July, then in the date order that they go in. So for example, if you accumulate this over a number of years, you can't choose to say, I want to access the contributions made in this particular year and not ones made in an earlier year. It will be those made in the first year are what count, and then you go to the second year, the third year, the fourth year, and so on, until you get to that maximum of $30,000 plus the associated earnings. If you have non-concessional, so post-tax contributions and pre-tax contributions made at the same time, the ATO will release the post-tax contributions first. So those that haven't had any tax applied, because that actually helps you maximize towards that $30,000 figure. Also, any contributions that you have made in the year that you are then looking to access will also be available. So it's not just those made in a prior year. Contributions you make this year could, in that year of access, can also count towards it. There's just perhaps some more confirmation that you need to do with the tax office to confirm things like, are you looking to claim a tax deduction for any of those contributions, so they can appropriately calculate what that amount is going to be. Because once they've done that, then the ATO will tell you exactly how much could be paid out to you. It is then after that that you will then determine how much are you actually going to receive. You then have to notify the tax office. So they might, as an example, say to you, you could access $35,000. So $30,000 plus maybe that $5,000 worth of additional money, additional earnings that the ATO has calculated. But if you turn around and say, I only want to get $25,000, then that's what will be paid to you. And you'll have no chance to ever go back and ask for that extra $10,000. So you need to be very careful and very conscious about the amount that is going to be selected. Once you notify the tax office of how much you want to access, the tax office will then go off. They will then go to the superannuation fund where your money is held and ask for them to pay that money across to your superannuation fund, across to the tax office. The tax office will then withhold any relevant taxes, which I'll come back to in a moment, and they will then send the balance after withholding that tax through to you, and that money is then available for you to apply towards the deposit of that home. Now, in terms of withholding any of the tax, when you normally save money through superannuation and you access it, then there may be some tax that is applied to it. And again, the tax office will look at it through this mechanism. The way that the tax office will look at it is they will say, when they release some of those contributions back to you, other than those post-tax contributions, they will essentially say some of those contributions should be taxed when it comes back. We're giving you a concession when it goes in. There should be some additional tax that is paid when it comes out to you. And they work out that amount of tax by determining what they believe your average tax rate is going to be for the year when they pay the money to you. But they then discount that by 30%. So again, that's where some of the benefit will come through to you. And you only pay the tax on that differential amount. So they only withhold that little bit. So as an example, if the tax office determine that your average tax rate for the year is going to be 37.5%, then they will say, we would tax the amount we're going to release. So the concessional contributions and the earnings coming back to you, we would normally tax that at 37.5%, but we'll take 30% off it. So we'll only tax you at 7.5% on that amount. Now that amount also then has to get included in your tax return for that year so that the ATO can work out what your actual tax rate was and apply the relevant amount of tax, but you still get the 30% offset. Now, importantly, if your tax rate ends up being something less than 30%, you don't get the benefit or an extra amount paid back to you saying, well, if my tax rate was only 25% and there was a 30% offset, you don't get the extra 5% back to you. You don't get that 5% to offset to anything else. It just basically means there will be no tax withheld at all on the money that's come out to you. And if they had withheld more than they should have, then you might get a little bit of a refund, but you can't go and apply it to anything else. Now, once the money has come through to you, you will then basically have up to 12 months to purchase or go and construct that home. Now, that home has to be a home in that sense. So it's towards a residential property. It is not to be applied towards commercial investments. It has to be a residential property that you're going to go and live in. There has to be an intent that you will go and live in that property within 12 months. If it's vacant land that you're looking to purchase, then basically you've got to have that intent of building on it and again getting into it within 12 months. So it's not one that you can say, yes, I'm going to build a residential property on it, but I'm never going to live in it. There are time constraints that are in there. If you can't find that property that you want to purchase within the first 12 months, you do have the ability to go back to the tax office and ask for an extra 12 months to go and find it. But if you can't find the property within that relevant 12 or 24 months, then you have a couple of options. Now, obviously, one of those is you can actually pay the money back into the superannuation system. Just knowing that because you had already requested access once, just remember you cannot go back and ask for it again. Even if you didn't utilize the money towards the deposit, you can't go and ask for access again in the future. So again, the timing about when am I going to go and choose to access this money is important. You need to do it within that 12-month period or 24 months if extended. If you don't pay the money back into the superannuation system, then the ATO will come through and will impose some additional taxes on that money that you have withdrawn. So again, it's important to be aware of that. The other point that's very important here as well is actually about the timing, because you may remember when we started this discussion, the start of this webinar, we talked about the fact that one of the requirements was that you had never sought access under this scheme before and that you didn't own property prior to accessing that money or requesting the access. So that's why it's important. You actually need to request this money before you go and enter into any contract to purchase that property. or to purchase that piece of land. Because if you have entered into the contract first and then you go and request money from the ATO under this scheme, they will actually say you already owned property before you came and accessed it, therefore they will not release the monies to you. But also, if you think about it, it makes sense to operate under this mechanism, because if you went to sign a contract and then went to the ATO and said, how much could I get? The ATO works that out, and then you say how much you want, and then the money's got to flow through all the processes to get to you. That will pass the time that you need to actually physically put down your deposit towards the purchase of that home anyway. So that's why the money gets released to you first, then you look to enter into the contract. And if you don't enter into the contract, either you ask for an additional 12 months or you pay the money back into the super system. So again, the timing is really important there to make sure that you do get it correct and that it's flowing through in the right mechanism. I guess one of the other things just to clarify when we say, it's towards the purchase or the construction of a home, there are a couple of little caveats that the ATO puts in there. So for example, you can't use it towards purchasing a houseboat or a motorhome or a caravan, anything like that. So it's got to be I feel like it's a property that is on a piece of land. If it is vacant land, then you can make sure that your contract also needs to cover the construction of the home, that you get into that within that 12-month period as well. So there are some rules that come in there. And I guess what that really says for me is, we've talked very generally here about how the rules operate, what the opportunities are, but you need to make sure that you actually go and seek some advice as to how it applies in your situation, because the rules for getting money into super are quite complex, and you want to make sure you do that the right way. You want to make sure that if your intention was to put the money into super to save under this scheme, you also want to make sure that you will be eligible to take the money out in the future. While superannuation is a great mechanism for saving for your retirement income, if that's not what your purpose was for putting the money there in the first place, you want to make sure that it's not preserved and quarantined in there until that future age of 55, 60, 65, or whatever it might be. The other one to think about as well, just before I turn to some of the questions that have come through, is another opportunity that does come up under this scheme is not only about how do you make it work for you, but it might be, whether it be now or at some point in the future, a consideration that you might have could actually be about how do I help my children or my grandchildren save towards the purchase of their first home? Because this is something that you can also do to help out children or grandchildren. You could look to put money into the superannuation system for them, knowing that the only way they can access that money is to actually get it out towards the purchase of their first home. It's not like giving it to them personally outside of the super system and hoping that they will spend it for the right purpose and not go off and spend it on something or other else when your intention was this money is just to use towards your first home. You put it in the system, they can only take it out for that purpose. And if they don't, then it's been a great benefit for them in terms of saving towards their future retirement needs. Remember that these rules also operate on a per individual basis. So if it's a couple, it's potentially, we're saying it's $60,000 between a couple towards the deposit of a first home. Because if you're thinking $30,000 isn't going to be enough towards a deposit, that might be right for an individual, but clearly, of course, it will depend on where the property is located and what it's valued at. But it could be between a couple that it's $60,000 towards it. And then what are the other benefits that might be coming through under some state scheme as well? And how does that all add up? And then what else potentially needs to be saved towards that deposit? So on that note, that concludes the formal part of the presentation, but I will look to move across to some of the questions that have come through so far. Now, again, the first question here was, can it be used to build on a property? Well, yes, you can use this towards the purchase of vacant land, provided that there is the home that's going to be built within 12 months of that purchase and that you will be moving into that property to live. So as we talked through, yes, it can work in that mechanism, but it won't work. You cannot access it if you have previously owned vacant land, because when we say you haven't previously owned property in Australia, it's about property, be that a home, be that investment properties, be that residential investment, commercial investment, vacant land. If you have owned property in the past, then you cannot access it. Another question that's come through is about what if you've never bought, but your partner has owned property before, and now you're looking to buy something perhaps jointly with that person? Well, if you personally have never owned, then you can access the money under this scheme. You can get $30,000 towards that deposit, but your partner can't. So if your partner had never owned property, between the two of you, it could have been $60,000 that you access. If it's only you that haven't previously owned property in your own name, then you can get the $30,000, but the property can't. There was a question about, can you use it to buy it for an investment property if that's your first purchase? The answer to that is no. This is about being your first home. And essentially, you need to live in it as your first home for at least 6 of the 12 months from when it's possible for you to enter into it. Things can change down the track, and you might look to move out or for it to become an investment property, but you have to have that intention personally of moving in there as well. There is a question about who should you go and seek advice from. Look, my recommendation here is that you should probably be speaking with a financial advisor in the first instance. And the reason that I say that is that this is all based off, am I eligible to contribute into superannuation, and how do those rules work? And you can only seek that advice as to how it applies to you personally if you go and speak with a qualified financial advisor. That is your first point of call. The second piece to be aware of is actually around the superannuation fund itself. And you don't need to go and find which superannuation fund offers this scheme. Every superannuation fund, because for them it's just about receiving contributions, then pretty much any superannuation scheme gives you eligibility here. There are some, you can't do it if you're a member of a defined benefit fund in relation to the defined benefit contributions in that fund, but if you're able to make personal voluntary contributions in addition to that defined benefit fund, then it's those personal voluntary contributions could be accessed. The whole scheme is administered by the tax office, so it's really just going to the tax office saying, how much can I access? They will then make contact with the superannuation fund based on the reporting and so on that comes through. There was another question that says, do eligible contributions only start accumulating from the 1st of July this year? Eligible contributions that can count are those that were made from the 1st of July 2017. So any contributions that have happened during this financial year up to now will technically be eligible to be accessed. You just cannot access until 1 July 2018. So the eligible to start saving the money towards the scheme is already in place, but you can't access until July 2018. It's probably an important piece to think about as well, because if you are thinking of saving under this scheme, it's probably important to be aware of a small quirk, might be the best way to describe it, that operates here. Now, I said before that the Australian Taxation Office will determine a deemed level of earnings on the contributions that have gone in that are eligible under this scheme. Now, the way that operates, certainly from the 1st of July 2018, is the tax office will have access to the information to say what type of contribution came into the fund and when did it go in. And it's from that date that they will work out what that relevant level of earnings are. And that is based on information that the superannuation funds have to report to the tax office. But that level of reporting doesn't actually start until the 1st of July 2018. So as a concession, because the tax office can't work it out for this financial year, they will actually assume that any eligible contributions that have gone in from gone in after the 1st of July 2017 up until the 30th of June 2018, they will deem or pretend that those contributions were made on the 1st of July 2017. So the deemed amount of earnings will be calculated from the start of the current financial year, which actually gives you a bit of a benefit because you get deemed earnings from an earlier date than any actual earnings themselves would have occurred. Just having a look at any other questions that may have come through. How does the genuine savings part happen? Do you need to have 3 months worth of saving or anything like that to confirm that it's there for a particular purpose? Again, this is administered through the superannuation scheme. So anything that's going in is truly a genuine savings in the sense that money cannot be released back to you unless you meet certain conditions, which normally will be retirement, or in this case, you need to show that you need to be eligible, so that over 18, never having owned property and so on. You're essentially making declarations to the tax office when you are looking to access the monies. You will need to confirm to the ATO when you have purchased the property. And if the ATO was to ever to do an audit and find out that those things weren't correct, then they can look to impose penalties on you. So obviously it's in a sense, it's a self-assessment, and it's about the honesty of doing the right thing of what the scheme is intended for.
Can I just ask you a question in relation to that, Brian?
Yep.
Because I think what they're saying is if I have to go to the bank to prove I've been saving for a property, can I get information from the tax department that I am putting money to my super save contribution?
Yeah, look, you certainly could, because again, essentially what you would do, now you would need to check with each financial institution as to how much they will rely on this, but you can, when you apply to the ATO as the first point in the scheme, it is about saying, how much am I eligible to withdraw towards the purchase of a first home? And the ATO will give you a notification. Now, you could choose to take that notification to your financial institution to say, I am saving towards the purchase of a first home. Here's what the ATO said I can access. They will only allow me to access that money towards the purchase of a first home, so there's some proof. But again, that's something you need to work with your financial institution, just to clarify how it actually operates. There was a question about how you should be looking to invest the money that you have in the superannuation system to maximise the return on your deemed earnings. Now, the first point here really is the way you choose to invest your money is a personal decision. Some people will look to take on riskier investments on the belief that they will get higher returns, and historically over the longer run that's what might occur, but it also means you've got more volatility, so you may lose out in the short term. Remember that the deemed earnings here is the tax office works it out based on some information that it's actually published quite regularly. There's a 90-day bank bill rate that they use, and they add 3 percentage points to that. So that's why I say at the moment that bank bill rate is sitting at about 2%, and then when you add on the extra 3, that's the 5% deemed earnings rate that currently applies. It changes on a quarterly, monthly basis as you go through. So the deemed rates of return will always change, and the deemed earnings will basically be calculated on a daily basis throughout the time of the money sitting inside the superannuation fund. So what that does though is it just highlights another risk and another reason to get some advice, because you could put your money into the scheme and you could invest high risk. And it might be that in the short term, up until the time that you want to take some money out, you haven't had a significant level of return come through, perhaps because of market volatility. And if the tax office says you can actually access not only what you put in, but also a deemed rate of 5%, you might be taking out technically more money than what you had put in and the earnings that you had generated on it. Now, whilst the scheme allows you to do that, you need to be very cautious, because that will actually eat into other superannuation savings that you may have, and therefore might impact on your future retirement plans. And that's why I say it's really important that you get some advice as you go through this to work out, how much can I put in? How much will I be able to access? How does that work for my own home? How does that work on my future retirement plannings? So the overall benefit of this scheme, and I'll just use this as the last question to finish up here. What's the overall benefit of this scheme? Look, it is a way that you can save money in a concessionally taxed environment. But you do need to compare what your options are. You can choose to invest personally. You can choose to just put your money in a bank account and let it accumulate with whatever interest rate you're able to obtain. Or you can do this via the superannuation system. The benefit of doing it via the superannuation system is the concessional nature of the taxation benefits that come through. So again, like all things, you're sort of saying it's 15% inside superannuation. What is the tax rate that I would have personally? What is the better way to do it? The 15% tax rate generally will look better for most people. But just remembering the money is locked away and you can now only access it towards the purchase of your first home. And if you don't access it for that purpose, it is locked away until retirement. That has benefits, but if you have concerns about access, that you might need the money for something else in the interim, then doing it through this scheme in superannuation may not be the best thing for you to do. And you should consider what your options are and just make sure you are making any decisions on a fully informed basis. So on that note, I'd like to thank you for your time, and I will now hand you back to Rob.
Thanks a lot for that, Brian. I'm going to say I certainly learned a lot more about how all this Super Save scheme actually works, and hopefully all of you out there have learned a lot more about it as well. Just to remind you, we will be sending out an email either later today or tomorrow with a copy of a recording of this webinar, so you can go back and have a look at it again. So thanks again, Brian. It's been absolutely wonderful. Thank you all for your time. There will be a quick summary or quick survey coming up after this finishes. If you just take that time to fill it in, that'd be absolutely wonderful. Thanks again and have a great day.